the comeback of the 10-year yield spelled doom for the housing recovery and the health of the U.S. economy. Joining us now on the Squawk Newsline is Marc Faber. He is publisher of the Gloom, Boom, and Doom Report. He's also a Squawk Box market master. Mr. Faber, welcome to Squawk Box. It's nice to have you back.
It's my pleasure. Thank you.
What to you seems more oversold at this point in time, the 10-year Treasury note or the stock market?
The stock market isn't oversold in any way, except for the next 10 days on a very short-term basis. But longer term, we're still overbought, not just in the U.S., but in many other countries as well. The 10 years is very oversold near term and intermediate term, and gold is even more oversold.
So are you a buyer of bonds?
I think as an investor, you need discipline and patience. And I think the best course of action is actually not to buy anything, but rather to reduce positions on a rebound.
Well, so reduce positions on a rebound. So you're selling into any kind of strength that we see, even if it's momentary, you're selling right into it? That's what you're saying?
No, I think the S&P could rebound to around 1630, 1640.
But then what's the downside on the other side of that, assuming you're trying to get out? You're trying to get out because you think it's going to go as far down as?
Well, I think the high was 1687 on May 22nd, and will go down 20 to 30%.
20 to 30%. Mark, what do you think of the other Mark? We have another Mark here at the table. Mark.
Well, Mark, what I want to ask you is you're there in Asia, and my view, or Highland's view on this, is that things in the emerging markets were not right before the FOMC meeting, that there were things going on in that space, a pretty big liquidation across the bond market, and we've seen it reflected in some very massive moves in certainly EM stocks and EM bonds. Can you give me your perspective on what's going on there with that market?
Well, basically, for the last 6 months or so, emerging market growth has been slowing down. And I have maintained repeatedly that growth in China is not as strong as the government statistics would suggest. And it becomes more and more obvious that China has a credit bubble, and not just a small one, but a massive one. And that if the Chinese economy slows down as much as I think it will, or even goes into no growth, then it affects the whole emerging market complex, because China is a very large buyer of resources from the emerging world. If they buy less, then prices of resources go down, of commodities go down, and these countries have less money to buy foreign goods, and so you have a vicious circle on the downside.
Yeah, we agree with you. I think.
Well, and I would listen to the market. I mean,
right.
Look, some emerging markets have tumbled by 20 to 30% since their highs earlier this year. Some have dropped 20% in 3 weeks. The emerging market bond fund is down 20% in a couple of weeks. I would listen to that and not sit there and say everything is fine.
You had a lot of investors searching for yield across emerging markets. You could buy a single A Chinese bank bond for 50 extra basis points versus J.P. Morgan, and that's probably something they don't want to own right now, given what Mark just talked about.
Yes. We also have to ask, why do people chase yield? Because of the brilliant central bankers' monetary policies that have kept interest rates artificially low, and many people depend on yield, as well as pension funds and insurance companies. So basically, the idea of the neo-Keynesian, or of Keynes, is to stabilize the economy and have less economic and financial volatility. What the Fed has created already with the Nasdaq bubble, the housing bubble, and the latest bubble is more volatility than less.
Mark, you say that you believe that central banks will continue to be buyers of physical gold, and therefore you're going to continue buying physical gold. What level are you looking for, and what's making up your thesis here?
Well, I don't think all the central bankers will buy gold, but say the Asian central bankers, that have very little exposure to physical gold, maybe just 2% of their reserves, I think they or the sovereign funds and well-to-do individuals will continue to buy it. Now, as you know, the gold price was among the best-performing assets between 1999 and 2011, and since then it's performed miserably and is down more than 30%. I think we can still go lower, but I wouldn't bet necessarily on going lower. The commercials have a very low short exposure, which would suggest that they think that the market will go up, and these are professionals.
Right.
Number two, if you look at commodities in general, whether it's oil, copper, or gold, or silver, the cost of production has gone up dramatically. You can't produce oil anymore at $20 or $30. The new production will cost you at least $80. Similar for copper, you can't produce copper at 60 cents a pound anymore. And for gold, I guess for new gold, the all-inclusive cost is around $1,100, $1,200 an ounce.
Mark, we have to let you run just quickly. Do you own U.S. stocks, any, or no?
I own some. I just bought about 10 days ago some gold mining shares, but other than that, I don't really own U.S. shares.
Interesting.
Okay.
Marc Faber, thanks so much.